All right, let's talk markets now with Stephen Parker, co-head of Global Investment Strategy at JPMorgan Private Bank. And you use the U word a lot, uncertainty. Although I think you want to be in the market, but you want to at least have some sectors that might not be down as much in a down market. Or you say you want to try and protect on the downside. How do you do that?
Yeah,
staying long.
We're telling clients this is a time when you have to be comfortable feeling uncomfortable.
Yeah.
That policy uncertainty means the range of outcomes is broadening out, but our baseline is that you should have a normal level of risk in your portfolios. And so, first and foremost, that means doing a health check on your portfolio. If you're sitting in too much cash, get invested. If you're overexposed to the U.S. markets and the dollar, think about adding some non-U.S. exposure. And then for those clients who are thinking more opportunistically around where are some of the sectors that perhaps we can see some upside given the sell-off in markets, we're pointing towards things like banks and software as some of our favorite plays.
Given the S&P is at 5,200, 5,300 after this morning probably, you think we go up from here, but the high end of your range would be flat for the year. That's as good as it's going to get for you, and it's pretty wide range, 5,700 to 6,200 on the S&P.
Yeah, I mean, this is a much wider range than we normally talk about, but it's also a recognition that market uncertainty is much wider, and particularly when that's driven by policy, it's harder to pin yourself to a single point. You have to think about where we are today, not where we were at the start of the year. So if you think about potentially markets getting back to all-time highs, even if that takes us 2 years, that's 8% a year. That's still a really compelling return for equity markets. And we also have to acknowledge that for all of the downside risks that markets and investors are focused on, the upside risks are there. If we get policy surprises in the positive direction, greater clarity around tariffs, we could certainly see an upside surprise that could take us back to the highs in the not-too-distant future.
When the year began, it was duly noted that multiples were rich. We had back-to-back 20% plus years. But still, the optimism in the business community about deregulation and DOGE and corporate taxes being flat for 2 years from 6,200 wasn't what most people thought would happen. I mean, so would it surprise you to see 7,000 in 2 years, 8,000 in 2 years?
I mean, I'm not ready to proclaim 7,000, 8,000, but I do think that the bar in terms of how investors are evaluating the markets has certainly come down.
Right.
Valuations have normalized, and the potential for positive surprise has certainly gotten better.
Maybe it was going to be tough sledding regardless of whether there were pro-business changes
I think
because of the last 2 years.
I think if you put the policy uncertainty aside and you just look at the fact that we've given back some of the gains, particularly in the parts of the U.S. market that have done the best.
Right.
As a result, valuations are much closer to what we would think of as new normal levels. That sets us up for more upside going forward. It may take us some time to get there, but all of the positive policy that you were talking about that everyone was using as their base case to start the year now has sort of gone out the window. If we start seeing some of that, that would certainly be a catalyst.
It's still there. It's just the tariffs are obscuring.
That's true.
Everything else because they're so front and center. You got specific sectors that you think would fare better, or
yeah, I think two of our favorite sectors are banks, who would be big beneficiaries of that potential for deregulation. And by the way, the other thing that everyone was convinced about at the start of the year was an increase in deal making. Yeah. That hasn't materialized, but that could certainly come back. And then the other place is software, where we've seen valuations come down meaningfully. We think that's going to be the best way to play the AI trend going forward. Okay.